Paul Nagy from Epsilon Direct Lending, welcome.
Thanks, Drew. Good to be here.
Who is Epsilon and what do you do?
Epsilon Direct Lending is a private credit asset management firm. We're Australian-based and we're focused on the Australian middle market corporate direct lending opportunity. What that means is we raise money from wholesale investors and we use that capital to provide well-structured, predominantly senior secured loans to Australian middle market companies.
Can you expand on the middle market lending sector and the types of businesses you actually lend to?
Sure. So we define the Australian middle market as companies generating annual revenues of anywhere between $25 to $500 million. And it's actually a universe that we really love. The middle market provides us with a deep opportunity set of diverse lending opportunities. So in terms of the types of companies we look to lend to, they need to have two components. Firstly, they need to be what we call performing companies. So they're companies that have a reasonable degree of scale within their operations. They've got strong financial track records, good management teams and the like. And they also need to be seeking capital to grow their businesses. They're two fundamental things we look for.
What is one of the biggest misconceptions about private credit?
Probably the biggest one that we find we come up against from time to time is that this view that all senior secured loans are somehow the same. And certainly within corporate lending, it couldn't be further from the truth. So at Epsilon, when we're looking to advance a loan, senior or otherwise, our lens is predominantly focused on being repaid from the future cash flows that company is generating. All of the work we undertake is concentrating on ensuring we get our money back from the cash flows the company's generating. If you contrast that with other lenders out there who their primary source of repayment might be a capital market event such as an IPO, you can see in a very similar, a very simple illustration there. There's two different risks that you're taking with either of those loans.
What are the benefits of advisors making an allocation to private credit?
I think, some of the well-known benefits of private credit includes addressing the challenges of generating stable returns, the diversification that you get, as well as protecting against the downside associated with equity investments. At Epsilon, the investor outcomes that we're focused on includes providing our investors with stable recurring contractual income, very much focused on capital preservation and ensuring low volatility in the returns that we provide. Absolutely focused on providing strong relative returns, particularly in the more liquid credit markets and as compared to some of our offshore direct lending colleagues. And then I think finally and helpfully in the market that we're going through at the moment, being highly inflationary, the loans that we provide are all floating rate. So in a rising interest rate environment, our investors really benefit from that additional return.
What are some of the most important traits advisors should be looking for in a private credit manager?
Private credit investing is challenging. It's not a homogenous asset class. Strategies differ considerably in terms of the risk-reward trade-offs. So incredibly sympathetic. And so I know it's somewhat simplistic to say, but advisors really need to understand that, including some of the nuances associated with various strategies. When it comes to corporate lending, the things you absolutely need to concentrate on, there's probably three critical components. Firstly, it's understanding the types of borrowers and transactions that your manager is targeting. You need to understand how those loans are structured, diligenced and put in place. And then critically and finally, understanding how those loans are managed throughout their contractual term to ensure that they're repaid.
Could you provide an example of a type of company you've lent to recently?
There's heaps of good stories. I think for us in our portfolio, we're very much focused on the non-cyclical areas. We want to be lending to companies that are trading goods and services and generating profits in all market conditions. So if I look at our portfolio at the moment, we've got lending exposures to companies operating in telecommunications, in healthcare, in education, consumer staples, food manufacturing, medical devices, by way of example.
Well, Nagy, thank you.
Thanks, Drew. Cheers.